Many dream of retiring decades early, but that vision often relies on a lie, that waiting for a higher salary is safe. Mathematics proves that delaying your investments actively sabotages wealth generation by removing the one element needed for growth to actually happen. To see the specific cost of waiting, we are running a simulation. We will track 3 identical financial goals staggered across starting ages of 25, 35, and 45. The results demonstrate that in the mechanics of building a portfolio, the element of time carries significantly more weight than the volume of cash you earn. We begin at age 25. This investor starts with a modest contribution, $500 a month, into a diversified index fund and leaves it to grow. This chart shows wealth progression over 35 years. Growth starts slow, but eventually curves aggressively upward as returns generate their own returns. By age 60, the portfolio is worth over $3 million. Crucially, the vast majority is generated interest, not out-of-pocket contributions. This investor secured a multi-million-dollar payout by leveraging decades of compounding to do the heavy lifting, rather than relying on their own labor. Now we introduce the 35-year-old. They are starting a decade late, but they plan to catch up by doubling the monthly contribution to $1,000. This chart compares actual cash invested. The 35-year-old parts with significantly more principal to bridge the gap. Despite that extra effort, they finish at age 60 with millions less. The person who started early still possesses a much larger total. Doubled contributions failed because they couldn't replace the missing decade. Without those early compounding cycles, the snowball never had enough time to reach its full size. For the 45-year-old, the situation is even more dire. To salvage even a basic $1 million retirement, they would need to invest nearly $3,000 every month. It illustrates a brutal reality. Your salary cannot scale fast enough to compete with the growth curve of an early start. But even a $1 million target might be too low. Most followers of the FIRE movement use the 4% rule to calculate their retirement spending. However, Dr. Wade Pfau challenged that rule by analyzing 109 years of financial data across 17 different developed nations. This chart shows global sustainable withdrawal rates. The thick red line represents uniquely favorable U.S. returns. The cluster below shows a 4% rate is actually risky elsewhere. To guarantee safety over 30 years, plan for a more conservative rate, like 3.5%. When your target requires a massive safety buffer, an early start becomes the only realistic path to hitting the necessary numbers. While these targets are high, this math also creates a path toward low-stress lifestyles like Coast Fire or Barista Fire. Securing your baseline early allows you to transition into a passion job while your investments coast to the finish line. Consistency and time will always overpower intensity. $50 today is mathematically superior to $500 a decade from now. Tell us your age and your target in the comments below. Then subscribe and click the next video.